If you don't hold gold, and I suppose also silver, I mean, there are other things, in this sort of catastrophe, actually having the means of producing your own food actually does become rather important. Living in cities puts you at a great disadvantage because the distribution of the basics which we need, I mean, particularly food, that's going to break down. I mean, who with, sort of producing, whether it's vegetables or meat or whatever, is going to want to sell stuff into cities for people who can't afford to buy it. Well, sorry, cattle, you're going to live a bit longer, sort of thing. I mean, that is a real trouble. If you have credit, you'll get wiped out. It's as simple as that. I mean, think what 4 trillion marks were, if you like. It was some figure like, I can't remember, but I think before the war, the total money in circulation was measured in sort of, I think it was measured in billions of marks, of Reichsmarks, not trillions. The UK and Japan are leading yields upwards at the long end. They're hitting new high ground, highest levels of years seen for a long time. And they're not the only G7 nations with this trouble. I mean, we've got Germany, notably. It's, the 30-year Bund is yielding more and more and more. It's just going into new high ground the whole time. Ones that are left behind a little bit, but threatening to break out. The most important of which is really the United States. If you look at the long bond yield, it was capped at about 5.1%. I think it's sort of, I can't remember, but 18 months ago, something like that. And since then, it's been oscillating between sort of 5% on the upside and sort of 4.8, 4.7 on the downside. But, the oscillations have dipped. They haven't dipped as far every time. So you've got this chart pattern, which quite clearly shows that the moment it breaks up above 5.1, that yield is going to soar. Just imagine what that does to US government finances. I mean, I think what it reflects is an increasing investor perception of risk in investing in US treasuries.
The U.S. long bond yield has tested 5.1% multiple times over the past year and a half. Each time it pulls back, but the floor is rising, signaling mounting investor concern. If yields breach this ceiling, borrowing costs could soar, compounding Washington's financial headaches. Rising interest expenses meet record federal deficits, forming a classic debt trap. Spending accelerates as revenues falter. This is not a U.S.-only issue. G7 peers like France and the UK are also struggling to rein in budgets. Yet America's role as issuer of the world's reserve currency makes its debt spiral especially consequential for global stability.
So why should they be worried about risk? Well, I think the answer partly is that the US economy is going into recession. And this means that the budget deficit will be far higher than currently expected, currently forecast by analysts and indeed, the Congressional Budget Office. If it does that, then from the point of view of investors, what they see is effectively a debt trap. And you've got debt traps really in all the G7 countries. And what a debt trap is basically a situation where the debt is soaring out of control, while at the same time, the revenue income that a government gets is declining. And so any sign that the US economy is stalling is very bad news when it comes to the yields on the long end of the US Treasury market because of the debt trap. And virtually all virtually all the G7 economies have this trouble. I mean, we've got riots in France because the government can't get through the necessary cuts in public spending to balance the books. We've got the same problem in this country. The government tried to balance the books by proposing some fairly minor welfare cuts, and that was thrown out by its own parliamentary party. And it's a different situation in the United States. You've got a spendthrift president who seems to be completely oblivious to the real situation. And he's saying he wants the dollar lower, and too late Powell should be cutting rates and all the rest of it, putting a lot of pressure on the Fed, I must say. And I see that Mirren, his nominee to join the FOMC, has been approved by the Senate committee, so that now goes up before the Senate. So it'll be, he's a shoo-in now, let's face it. I wouldn't be surprised if Trump starts pushing him to be the next, president of the chairman of the Fed, replacing Jay Powell, because he retires next year. I mean, so really, we're looking at a situation where public sector spending in federal spending in America is increasing at a phenomenal rate. The recession, I mean, look at the unemployment numbers. The recession that is now becoming more and more obvious means that will be even higher. The budget deficit will be even higher. And yet you've got a president pushing for a weaker dollar. I mean, it's going to go weak anyway on that basis. And you're going to get higher rates at the long end, whatever happens at the short end of the yield curve. I mean, it's not good. It really is not.
Behind the yield curve drama lies economic weakness. U.S. unemployment is ticking higher, manufacturing is slowing, and small businesses outside financial centers report sharp struggles. Recessionary pressures widen deficits as tax receipts shrink, while welfare and stimulus spending balloon. Political leaders, however, remain divided. In Europe, reforms are blocked by protests in parliaments. In the U.S., expanding federal spending collides with calls for austerity. Pressure on the Federal Reserve intensifies, cut rates to aid growth, or hold firm to tame inflation. Leadership changes at the Fed could soon shift policy, adding another layer of uncertainty to already fragile markets.
The term stagflation actually amuses me slightly, not just because it was my uncle who came up with it in a debate in the House of Commons back in, I think it was in the late 1960s. It wasn't quite in this context, but it is being picked up. I mean, the fact of the matter is, and this is something which Keynesians don't understand, macroeconomics, economists don't understand, is that production is linked to consumption. Basically, when you get a recession and people get sacked, then their productive ability within the economy declines. So, because guess what? Things are bad, you cut production as well as, consumers cut consumption. So the thing sort of goes along. The most important thing actually is not, whether that's true or not, but really, if you get a decline in the value of the currency, which of course, with currencies being entirely fiat, is not that unusual, then the purchasing power of the currency is going down. So inevitably, the costs of things measured in a declining currency go up. And so this is the explanation for stagflation. And I mean, the economists who denied Say's law, which was their sort of, if you like, sort of fundamental tenet of classical economics, just completely ride roughshed over the experience, if you like, of previous inflations. I mean, when you get a massive inflation, what we call a hyperinflation, then, is this accompanied with a booming economy? No, it's accompanied always with a collapsing economy, yet prices rise.
The term stagflation, once coined in the 1960s, is back in headlines. Unlike standard recessions, stagflation combines economic stagnation with rising prices. Mainstream economists often misread the dynamic, but history shows collapsing production and inflation can coexist. When currencies lose value, import costs surge, driving inflation even as real economic output contracts. Hyperinflations, from Weimar Germany to Zimbabwe, proved this devastating mix. Today's weakening fiat currencies risk the same trap: shrinking purchasing power, declining productivity, and social unrest. For households, rising food and energy bills bite harder than official statistics suggest, creating a reality far worse than political leaders admit.
So how do you get the situation where you get a collapsing economy and inflation and you get surprised by it? I mean, it's inevitable that the two things actually go together. So the Keynesians, by trying to dismiss Say's law, have got this one completely wrong. So to me, what we call stagflation is actually quite a normal phenomenon. So, and that's basically where we are. I mean, if you look at the recent unemployment numbers, also go around the States just as the same as I go around Britain and talk to people not in the major financial centers who are on a different planet, but go and talk around Main Street, smaller companies, small and medium-sized companies, ask how they're doing. And you'll get a completely different answer from this sort of hype that, oh, the economy is going well, etc., etc., etc. It's not. Things are actually not that good out there. Prices are higher or rising faster than the statistics suggest. That's a very important point. We're also seeing food prices, more importantly, rising really quite quickly. And unemployment, I mean, the jobs just aren't there. I mean, I don't care what the BLS says. I don't care whether Trump is right about, they're getting it all wrong and all the rest of it. The fact of the matter is that government statistics are self-serving and they are not accurate. Just go around and see what's going on in the economy and you'll get a far better idea. And I'm not in America, but I can tell you here, and I guess the same is there, that the economy is actually in decline. And we can also show this mathematically in a way in which economists fail to do. Just take the budget deficit, which in America is around about, 6.5–7% of GDP? Take that out of GDP, and what do you get? You get a contracting private sector GDP. There's your evidence. I mean, in other words, GDP is falsely being wrapped by the government deficit. Government deficit 7%, GDP growing nominally about 4.25% or something like that, means that you're actually contracting by somewhere between 2 and 3%. And it's been doing this for a couple of years.
The echoes of Weimar Germany's 1923 collapse are chilling. Then, runaway money printing destroyed the currency, wiped out savings, and destabilized politics, ultimately paving the way for extremism and global conflict. While today's situation differs, parallels remain: unmanageable debts, weak currencies, and disillusioned citizens. If confidence in Western fiat systems breaks, gold and silver may regain roles as stores of value. Historical patterns suggest that in crises, those with tangible assets, land, food production, precious metals, fare far better than those relying on paper money. Ignoring these lessons risks repeating history's mistakes on a far larger, interconnected, and more fragile scale.
If you don't hold gold, and I suppose also silver, I mean, there are other things, in this sort of catastrophe, actually having the means of producing your own food actually does become rather important. Living in cities puts you at a great disadvantage because the distribution of the basics which we need, I mean, particularly food, that's going to break down. I mean, who with, sort of producing, whether it's vegetables or meat or whatever, is going to want to sell stuff into cities for people who can't afford to buy it? Well, sorry, cattle, you're going to live a bit longer, sort of thing. I mean, that is a real trouble. If you have credit, you'll get wiped out. It's as simple as that. I mean, think what 4 trillion marks were, if you like. I mean, it was some figure like, I can't remember, but I think before the war, the total money in circulation was measured in sort of, I think it was measured in billions of marks, of Reichsmarks, not trillions. even possibly millions. But I mean, it was a very, very low figure. So, if you've got unbacked fiat dollars, they're not going to buy you a cup of tea at the end of the day. On the other hand, if you've got gold, you can cash that in for worthless dollars, which you'll spend extremely quickly before they become even more worthless. I mean, that was the lesson, really.
Global economies are edging toward a dangerous intersection: soaring debt, weakening growth, and fragile currencies. Official data often masks the severity, but everyday reality, rising prices, job losses, and business closures tells the truth. If deficits drive artificial GDP growth, private economies are already contracting. Investors seeking protection increasingly turn to hard assets like gold and silver, which hold value when currencies crumble. For individuals, resilience may mean securing essentials, food, energy, and savings outside fiat systems. The coming years could bring instability not seen in generations. Understanding the risks now may be the only path to weathering what lies ahead.
Of that experience. And not only that, but if you do have gold, and particularly if you've got legal tender, it varies, the laws vary from country to country, but if you've got legal tender, then you can presumably use your gold to buy real estate, for example, or buy farmland, or nice country estates, or a hideaway away from anywhere, which might insulate you from trouble. But I mean, this is a very, very serious issue. It's going to be very damaging for virtually everybody, because let's face it, very few people actually have gold, or have gold in any sort of meaningful way. I mean, we haven't even touched on problems that follow. I mean, if we pursue the analogy with Germany, of course, the complete collapse of the currency and the economy in 1923 led to political instability. It led actually to Nazism, Hitler, and all the rest of it, and World War II. So the idea that this is just going to get the whole thing out of get it out of the system, and then we can get on with lives, and it's not that simple. It really is not. So you're going to continue to be very wary about the situation following what is now looking like going to be a great inflation yet again, a collapse of the currencies, fiat currencies. And the thing that is actually very worrying is I can't see how any politician in the West has the mandate to actually address the problem. And it's in that context we should be more sympathetic about the problems that the German political class felt or faced back in the early 1920s. I'm sure, and if you read into it, you will find that there were people who knew what they were doing. They knew that what they were doing was wrong, but they basically had no alternative. That was the way of it.